Welcome back, folks. This is our final review for the month of January 2020. Very quick it went by, didn't it? So we're looking at our economic calendar for the week to come. For Monday, February 3rd, we have final manufacturing PMI, medium impact for GBP, London session, and 10 a.m. we have high impact ISM manufacturing PMI. And later on that night at 10:30 p.m., you have high impact cash rate and RBA rate statement for Australian dollar. And then Tuesday, the only economic release of any importance for the pairs we follow is at 8:30 p.m. Aussie dollar high impact RBA low speaks. And then we have Wednesday, London Open medium impact final services PMI, 7:15 a.m. high impact ECB president speaking for euro dollar. 8:15 a.m. high impact ADP non-farm employment change. 8:30 a.m. Canadian dollar medium impact trade balance. 10 a.m. high impact ISM non-manufacturing PMI. 10:30 a.m. medium impact crude oil inventories. Watch Canadian dollar for that as well. 12:30 medium impact Canadian dollar speaker. And 7:30 high impact during the Asian session. We have retail sales for Australian dollar and trade balance for Australian dollar. So a couple different opportunities for low resistance liquidity runs for Australian during the Asian session for this coming week. And 3 a.m. on Thursday, high impact, we have no speaker. 5 a.m. medium impact economic forecasts for the euro dollar. 5:30 p.m. again, Australian dollar high impact and monetary policy statement at 7:30 Australian dollar. And Friday, non-farm payroll Friday, 8:30 a.m. high impact Canadian employment change, unemployment rate for Canadian dollar, and average hourly earnings and non-farm employment change for dollar, and unemployment rate for dollar as well. Okay, so we're going to be looking at the dollar index, euro, GBP as we normally do, and the price action lesson will be for index futures, example for E-mini S&P. Okay, so we're looking at the dollar index as our daily chart, and as you have been prompted on Twitter right before this video was produced, I said go back and listen to the video, because otherwise you're not going to listen to the things I said, and it's going to sound like I'm pulling things out of thin air. All right, we're looking at the SIBI here. The overall interbank draw was up here on the buy side liquidity. As I mentioned in that video, it's not that I'm saying it's going to go up to that. Okay, I didn't say that we're going to go up to that. It could have, but we're looking primarily at this area right here. And if it goes up into that area, it could rebalance to that point and then sell off. We were looking at for Thursday, because in Wednesday's midweek review, we'd probably get the British pound rate announcement to spike us up into 98.23 just by a little bit, and then potentially sell off aggressively, attacking the lows down here, as we'll look at when we go in the lower time frame. As Thursday shown, we were unable to go any higher, and we just rounded off the swing high, and then expansion on Friday. The January 31st Brexit, more or less deadline or whatever, came to fruition on Friday, and that's what caused the upside lift on GBP, which is also counterparty to the dollar index dropping. Now, I want you to look at the small little fair value gap that was in here residing. I did not have this identified, but I found it interesting that it went down to that when going to the lower time frames. I did go back and listen to the video again. You'll hear me say that if we go up here, we could potentially hit this 98.23, and then if it does it on the news of the rate announcement on Thursday, or last Thursday just passed, for GBP, the catalyst could be the sell-off aggressive. And we didn't get the 98.23, but we did get the aggressive sell-off. And I said that we were probably done for the upside into the SIBI. Majority of the volume for the week for upside expansion was pretty much behind us, with the exception of GBP. And obviously we'll see that Moving into the hourly chart, you can see we have a market structure break here. High, low in between, higher high. So we had buy stops rated here. Breaker, after market structure shift. There's your return to our market structure break and bearish breaker. And then the expansion on the downside. Now this is the old 2018 high. This is the old 1 hour BISI, and this was a sell side liquidity pool I mentioned in the recording on Wednesday, that should we get that 98.23 and then break down aggressive, then we would probably upset the liquidity that was over here in this consolidation. Everything changed on Thursday with the market structure shift, and then we trace back to it, and optimal trade entry sending us down into the liquidity here, as I mentioned in the video on Wednesday. If you look at the swing high, the swing low, it takes us right back up to a perfect 62% retracement, optimal trade entry, then expansion down to the negative 1.5 level, which is 97.36, and it went down to a low of 97.35. If you look at the levels on here, it's negative 127, negative 150, negative 2 even, and then the 0, 50 level, 62, 79, and 100, or 1.00 level. That's the fib levels that you're probably going to want to ask me, and that's what's clearly shown here. Okay. Moving into the 15-minute time frame, you can see a closer view of all of the imbalances in here. Small little fair value gap in here, rebalances to that. Trades back up into the old fair value gap. This is the low of that fair value gap from the daily chart. Trades up into it, creates a small little fair value gap, comes back, consequent encroachment, and sells off aggressively through and pauses around the 2018 high, and then distribution. Fair value gap in here, price rebalances to that again, and then has another level of distribution come in. Trades into the old hourly fair value gap, and then comes back down, bounces at the low of the fair value gap, and then trades below it into the fib level as I indicated on the hourly chart. My concern is, did we come down here aggressively on the heels of the Brexit move for England? So by having Brexit more or less begin or take place, as one might say, I'm sure the folks over there in England would otherwise basically have a different opinion about what's going on. I've been, especially for the folks that just joined, I've been very candid with everyone throughout this whole process with GBP. Unless the chart has been considerably obvious, I have not been willing to say this is what's going to happen and I'm going to trade on it. I've been really like hands off for the most part for cable because of Brexit. I'm learning all of this with that pair just as well as everyone else is. There's no one out there that's going to know for certain what this pair is going to do as a relationship to Brexit or not. Seeing Brexit come to fruition, it's so uncertain, and that was really the context as to why I said on Wednesday's midweek review that it could go 50-50 up or down. It was a toss-up, but because I'm obligated, go back and listen to the video, I'm obligated to tell you what I believe it may do. And I still thought that 98.23 could have been stabbed on the rate announcement on Thursday, and this whole price action here would have been the catalyst for that. That's pretty much where we're at. Go back and listen to the video again. You'll hear all those points. It's within the first 5 minutes or so of the Wednesday video. Now, what I'm wanting to see this week is, did we come down here aggressively just to upset sell side liquidity and get below that consolidation as we shown on the hourly chart? Let's go back to that hourly. Did it come down here to take out this? Okay. And then will it try to trade higher? That's what I'm wanting to see this week. This may have been just an overzealous move in response to the repricing of GBP, and we'll probably get that indicated in price action this particular week. We don't have a whole lot of GBP news, as you saw on the economic calendar, but I think that moving ahead it'll be interesting to see how we react to having gone down to where we are. It did it in pretty quick fashion, as I mentioned on Wednesday. Should we have gotten to 98.23, we would probably see it trade down to where we're at right now. Because it didn't do that and it left the imbalance up here, it would not be a surprise for me to see price come all the way back up there and just completely remove all of the sentiment that's priced in right now. The European Union is going to probably go out of its way now to punish England in its choice to leave. And that's my personal opinion, and I don't have anything really to lean on in terms of saying this is why. I just think that obviously the European Union members want to see the members stay. And if one is able to leave, and that's really not the intended purpose of the European Union, they're probably going to try to make an example out of England. And it'll be interesting to see how they do that with their currency. So while it may look like it's all good and fanfare and it's peaches and cream and they rally the pound higher, that may have been something of an illusion, and they may reprice it lower, or they may send it higher to more or less instill economic pressures with trade. So it'll be interesting to see what they do with it this particular week. All right, so euro dollar is our daily chart. And while this looks like a whole lot of movement, it's only because we've had very small daily ranges for such a long period of time. It's nice to see it. I love seeing it, but we'll see how much of a continuation we have, if at all. As I mentioned before, the context is we had several attempts to go higher relative equal highs. We've had a breakdown. Market structure is still showing a market maker sell model. This actually doesn't change anything. If it does trade above this fair value gap, that would change the underlying market maker sell model. It could trade up into this, go to consequent correction, or completely fill and then reject, and that would still allow this market maker sell model to be intact. If we trade above that, then I'm absolutely wrong in the sense that it's going to go for the sell side liquidity. That's the reason why I have the anchor there, because I still want to see evidence that it wants to go lower. This could have, again, just been sympathy rising with the cable going higher on its January 31st Brexit and overzealous decline on the dollar. So we'll see what we get in relationship to all three this week. So I'm not convinced yet. Okay, I'm not trying to look at this and get overconfident or read too much into it. So I still think this is a draw on liquidity until this area is breached. If it's breached, then no problem. It'll be easy to go get in line with a run for the 112s and maybe 113s. But I'm not subscribing to that at this moment. All right, see the hourly chart for euro. You can see we had a market structure break here. Came back down. That level is the daily bullish order block. And again, let me go back to the previous slide so we are all aware of what we're talking about here. This down close candle, the opening price is that 110.20 and 4 pipettes. And that's that level here. So we have optimal trade entry here after market structure shift. And optimal trade entry and bullish order block, revisiting that on Friday, and then the expansion in sympathy with the Brexit. The fair value gap that resides on the daily chart is noted here. You can see it at that 111.20 level, 111.30 on an expansion, taking us above buy side liquidity that would be resting above these relative equal highs. 15-minute time frame again. You can see we had really nice returns into rebalancing fair value gaps in here. As a new member, as a new student, what you want to do is have your charts, don't do this with mine, on your own charts. You want to go through and draw in annotations wherever you see a gap, like this is a fair value gap, it comes back and rebalances, then we have an expansion on the upside, and then how prices reaching potentially into this fair value gap. It may not get there, okay? It may not do it, but that would be the next premium array on the upside that I would find of interest, because it would clear the 111 and allow about 20 pips above 30 pips above to get into that. And that's the narrative I'm going with. If it really ramps up, we can see 111.40 because of the protocol. Anytime we go to a big figure is like 111.00. Okay, if we trade up through that on strength, it could many times expand and price will spool 10, 20, 30, and as much as 40 pips above the new figure because there's a lot of interbank liquidity above big figures and below big figures. Moving on into cable. This is our daily chart. As you can see, we're still inside of a very small trading range. It looks dynamic, because of the small ranges here, but it hasn't been a whole lot. The buy side liquidity pool that rests above this high here, does it get there this week? I don't know. I'm looking at them to having taken out these highs here and then maybe attack the sell side liquidity here. And then if we get that recapitalization in the dollar, having traded down into its daily fair value gap and rebalancing. If this has just been a knee-jerk reaction that central banks have tried to pull a fast one, and that's kind of like where I'm leaning right now. I'm not subscribing to any really one-sidedness. I want to be flexible. Also, it's non-farm payroll week, so our protocol for those that are new, we look for our trades on Monday, Tuesday, and Wednesday by New York session. If we haven't secured a position by Wednesday's New York session, we don't do any new trading or entering new positions. Now, if we do have positions that are opened prior to Wednesday, 7 a.m. New York time, then we can manage them, but we need to be taking a good portion off. 50 to 75% should be removed because of the uncertainty that always comes by way of the economic reports resulting from the employment numbers, because those are typically a gamble. There's really no way of interpreting what's going to come and how the price is going to behave, and we'd never trade non-farm payroll Fridays. It just doesn't happen. We don't do it. And the day before, which is Thursday, every single month, we don't actively pursue trading those particular days. So I want to see what we do if we give all this back. If we gap higher, come back and fill the gap and then trade above this high here, then that would really indicate that it wants to go higher, and then maybe 135 could be in cards. But it would need to be that scenario. Otherwise, I'm just playing it by ear. I'm not looking for anything spectacular. I'm looking to see if they fade this whole rally they did on Friday. On the hourly chart, you can see again, Brexit is the theme going into Friday's trading. And I want you to take a look at how we had moved below these equal lows from the previous weeks, not Wednesday's review. Go back into the previous week when we were looking at the price action for, let's see here, this is that Friday. Wednesday would be here. Yeah, so Wednesday when I did the review of this week on the 22nd of January, watch that video, and if not that one, look at the weekend review. And I'm quite certain it was the weekend review, if not the 22nd. Yeah, I'm almost certain it was the weekend review, indicating that we would come down and fill the BISI in here, which is the fair value gap, and run the equal lows here. And then we got that traded into that this week. So we traded down into it. We worked on that level multiple times on the low of the gap here. If you're new, you'll learn what fair value gaps are. Please don't email me because all of it's taught in the content. But we had multiple times stabbing below that. So they went through it, one more time lower, and then rejected it. And this was on the heels of the failure to go higher on the dollar and also the rate announcement for GBP. And then rolling that into Brexit's deadline, January 31st. Running buy side liquidity over here, and we'll see if it wants to expand up into that level. I'm not terribly convinced at this moment. I don't know. If I had a gun held to my head, I would just beg for mercy because I couldn't tell you what direction this particular pair wants to trade because of the Brexit uncertainty. So as a mentor, I want to convey in my most honest manner, if I don't know something, if I don't feel confident about something, or if it just doesn't give me enough information, I'm going to tell you. And this is where I've been with cable. And for the most part, cable's been acting really strange anyway. This movement here if anybody wants to make a big deal about that and say, well, because you missed that, whatever. Because I wasn't watching this pair that much, that's why my attention was on crude oil and the S&P. So for the hardliners in here that want to assume that because I don't know and didn't have confidence in trading this particular pair, therefore, either I'm not as good as I claim to be, you failed to observe that our attention was on crude oil, which worked out beautifully, and you watched that I traded the S&P 500 E-mini contract on Friday, and that was an actual live trade. You can see it being handled in the TradingView platform. It wasn't a delayed data chart. It's as it happened, and it works. So if I don't have an opportunity in the markets that I follow predominantly, which is the euro, dollar, and cable, it doesn't mean I do nothing. I mean, I'm looking for an opportunity in another asset, and it may be Australian dollar, which has performed beautifully, or it can be the dollar CAD, or it can be gold, or it could be oil. And as we have been indicating the latter portions of 2019, I'm going to start segueing into commodities a little bit more. It does not mean I'm abandoning Forex. I will always be talking about euro and cable and Aussie and loonie. It just means that when it's beneficial for you and it allows me to convey a new lesson or teach on things that are germane to price action, I will use a commodity. Okay, and the index futures is a commodity. That's the area inside the commodity realm that they reside in, the index futures. So it's the E-mini S&P, the mini Dow futures, and the NASDAQ futures. Okay, we will start looking at bonds when they move a little bit more. To me, they're still a little bit consolidated. I'm not really impressed with what they're doing right now. So that's the reason why we've not touched on interest rates, and they have to get moving a little bit more for me to be interested in giving some insights about that. I'm looking at bonds in the same capacity that I have been staying with cable. It's just not real clear for me, so I'm leaving it alone. So there's the reasons why we haven't touched on that. And when we get into May, we'll be looking at a lot of the grain and livestock commodity markets and look at some seasonal tendencies that take place in the springtime. And we'll work into other things as we go out through the rest of the year. Moving on into the 15-minute time frame for GBP. Okay, I want you to look at this area here. We have equal highs and prices consolidated around that. Anyone else out there that has been familiar with the things I've been teaching, because if you look at everybody on YouTube now and on social media, everybody has the equal highs, equal lows indicated on their chart, and they're coming up with their own little secret names to make it look like it's original to them. Prior to me talking about all this stuff, everyone used the equal highs as a reason to go sell and go short, and double bottoms were reasons to go long. And I've turned that whole thing upside down. And this is one of those times where adding context changes that whole idea, where we're not looking at these equal highs to be a target and then reversal. We're looking at an area right above this is going to be liquidity. It's going to be buy side liquidity. Okay. And those orders, when they get rated here, yes, smart money can sell here. But when they have this run up here like that, they'll aggressively take it lower below that low. And this is where support and resistance ideas kind of like irritate me, because the idea is this: when we have equal highs and that resistance is broken, the idea is, okay, well, it's going to come down there and touch that level, because I demanded this level of precision when I saw it in the books. I tried to trade commodities and I wanted to react exactly at the old highs, and it didn't do that. What it does is it runs in deeper. What is it doing this for? This run here doesn't completely close in the imbalance. This one does. So it's not a matter of old highs and then look for it to bounce there. You want to look at the imbalance that resides right below that, because if we can see an imbalance there, that's where it's going to go to. And then you'll get that move here higher. So the context is equal highs are allowing buy side liquidity to be scaled off on longs. Then the new trap is this: they want to send it higher, then back down below it and then rebalance here. So what will happen is this level will be seen as support, but then once it breaks below it, that'll get traders thinking, okay, it's short. It's a short now. It's not a long. Okay, it's not a resistance turn support, and they'll go short chasing it, and then they'll put their stop loss rate above this high. And if you look at momentum indicators and such, you'll see all kinds of bearish divergence in here, and they'll grind it all the way up here. They don't want to do this run here fast. They do that very slow and lethargically, because they want to let people think that this is, not a run on their stop. Maybe it's just going to be a retracement and then go lower. That's not what typically will happen. And price runs again on the news of Brexit. And it just, to me, it just looks like it's being completely manipulated and held into a pull higher to get people thinking it's a good thing. It's going higher. It's going higher. It's going higher. And I'm not going to subscribe to that yet. All right, so we are at the price action lesson portion of this week's weekend review, and it's going to be on the E-mini S&P 500. All right, so we're looking at the daily chart of the E-mini S&P. Now, what this means is you're trading, or in this case, we are monitoring and studying the price action of the E-mini S&P futures contract, and this is the March delivery. Now, that means it is an expiration in March. So, for instance, when we get to the month of April, this particular contract that keeps track of the highs and lows each day for that delivery month, it will expire, and April will no longer be using the March contract. We'll be looking at the June contract. The delivery months for index futures are March, June, September, December. Okay, so it's only 4 per year, and they are the delivery contract months. It's the same thing for the bonds as well. So what we're looking at is the price action that's the nearby contract for index futures S&P. Every 1 point, for instance, if we were looking at where it closed on Friday, 32.24, if you were long and you bought it and it went to 32.25, that's $50 increase. So you made $50 per point, or 1 full point, or 100 points, I should say it that way. It typically will move in quarter points. So it'll go like 32.24, 32.24 and a quarter, 32.24 and a half. It'll move in those types of increments. It's not like pips where it goes in very, very small pipette movements and fluctuations. It usually moves in quarter points. So what I want to show you is when we have an opening weekly gap, this is such a classic 1990 scenario from my inner circle trader stuff. I used to do this pattern every single time it opened up, and same thing with the bonds. So this is a pattern that's very specific to index and bonds. Usually you'll see folks, they'll say, okay, this is the gap here, the low, and where we opened at on the new month, the new Monday. And that's the opening gap, everybody will say. For bonds, that means the 30-year treasury bond and the S&P 500. Okay, this is the same thing for if you trade the NASDAQ futures or if you trade the Dow futures. Like if you trade Dow futures, each point is worth $5 and the E-mini is worth $50. And these are very approachable markets. You don't need a whole lot of money to trade them, but you do need to know what you're doing. And what I look at is the previous Friday's close, because that's the real gap. Where we stop trading on Friday and where we open up on Monday, that's the real gap. You don't want to use the low, okay, because it's going to throw you off. So wherever that low is, we don't care. We want to find the previous Friday's close and the Monday's opening. And when you get that, you define the price like this, and this is your opening gap. Once you have this information, we're going to be anticipating a come back into the range and go back to that previous Friday's close. That's the draw on liquidity. When there's a gap every week on S&P or index futures in general or the bond market, you want to see it try to get back to Friday's close. Now, the same thing is seen if it's reversed. just in the opposite. So if we have a higher gap opening on Monday, we want to see it trade or anticipate it trading back down into Friday's close. So it would be just basically the opposite of what we're outlining here. So moving into an hourly chart, right away you'll see that it doesn't line up with anything in here that would be otherwise, classic idea of a gap. And we're not using this as the closure of the gap. Everyone that sees this low, when price does come back up into it, if they sold short here, they lost, and then they held a area of equal highs, so they built a pool of liquidity just below the previous Friday's close. You don't see it here because we're looking at it on an hourly chart, but this is the close on Friday. There's equal highs, obviously the same protocol. We anticipate those potentially getting rated. Price is consolidating. It did not go below these equal lows, relative equal lows, and then they sent it higher to clear the buy side liquidity, close the complete weekly gap to previous Friday's close, and then all of this is buy side liquidity being purged with the expectation price will run for the pool of liquidity here and over here. So there's a huge pool of liquidity below 32.40, which is the reason why I said in the recording I did on Friday that 32.40 is a level I'd like to see it trade down to for the day. But also, if it goes below that, we could really see it sink. And it went down to, I think, a low of 32.13, if I'm not mistaken. I think it's the low that was for Friday's March delivery contract. So we're going to take a look at a very specific element that you've been introduced to, and this is why my content is not supply and demand. It's reading smart money and their movement in and out of price. And what we do is we look at this level in here, which is our fair value gap. Now, I've taught in previous lessons how we can keep our fair value gaps on our charts, and they have expirations based on the up-to-data ranges. And again, charter members will get more information on that when we go into the trading plans. Inside this run above the buy side liquidity, okay, this area here, this whole little rectangle, that's going to be a supply zone, okay, for traders that trade supply. I don't subscribe to that. Okay, I make a mockery of it all the time, and for some of you that are students of supply and demand and you've been with me for a while, you can see it's night and day different. It only looks similar because I draw a rectangle on a swing low, and this naturally assumes it's supply and demand. So the rules of supply and demand, you can't cut through candles, and that's one of the things I love doing because that's the only way you're going to get the context. So when price was trading in here, okay, we have to cut through this candle. All of this run here, I'm cutting through that, and I'm not expecting it to get back up into this level. Why am I not expecting to get up into here? Why am I not expecting to get to this big, beefy, bullish candle that would be what? A bearish order block, correct? Sure it would, but not if the context has this scenario over here. Okay, we have equal highs. They already ran those stops. So it's not necessary for it to go that higher than what we need in this fair value gap. So we have the fair value gap divided by the close of this candle and the high of this candle here, which is encompassing just that one singular candle. That's your SIBI, sell side imbalance, buy side inefficiency. Again, new students, it's taught in the commentaries and in the lessons. Trust me, you don't have to email me. You will see it. You already have lessons available to you. Just go through your commentaries and you'll see certain topics or lessons that I will give a brief description of, and you can find information on this. So anyway, the fair value gap in the form of a SIBI, we extend that through out in time, and all of this run up here in this bearish order block, we don't need it to get up to there. We do like to see it be sensitive at the low of the fair value gap and consequent encroachment. That's what we see here. Okay, consequent encroachment is the midpoint of a gap. It can be in the form of a delivery gap or a volume imbalance where there's actually no candles there at all. It's just a real common gap. Both instances in the middle of that is consequent encroachment. That's what we allow, or we anticipate price moving that far into the gap without actually closing it. So we have price moving up into that level in a small term, more or less a short-term retracement, and anticipating price aggressively selling off. attacking the sell side liquidity at 32.40. I use 32.50 because I'm not trying to teach everything on Twitter, and it was enough to just answer somebody that asked me if I traded S&P mini futures, and it was me being facetious like always. So looking at it on a 15-minute time frame, we're going to take that same fair value gap and look inside of the range on a 15-minute time frame. We can see another fair value gap resides inside of it. And again, it goes to consequent encroachment, or the midpoint of that shaded area. So we have two levels in agreement for fair value. If you have an index futures or a bond market, okay, it could be your 10-year if you're trading that, the 5-year if you're trading that, or the 30-year treasury. Regardless of which one you're trading, or if it's the NASDAQ futures, the Dow futures, or the E-mini S&P futures, if you have two levels like this after a run on buy-side liquidity, you want to see price aggressively move lower. Once it does that, you want to find the first short-term low. That's this one right here. All I did was use classic support and resistance, but using the proper context. This high here, you can see, we went back up into it here, and then it sold off. That was my entries in there. And that's the reason why I used such a short-term, tight little stop, because I felt very confident that we would not go back up above inside of that opening weekly gap, which is the level here, 32.69 3/4. That's how precise you can be with the S&P futures or the NASDAQ or the Dow. There are so many professional institutions trading these indices. You don't get a lot of wild, stupid little wicks that run through orders, okay? Like you can see that happening in Forex because there's a whole lot of money available when you do that. Not that there isn't a whole lot of money in indices or trading the futures market. It just means that they conduct themselves a little bit more professional. And that's why instead of trading like stocks, or instead of trading like grain futures, if you're a commodity trader and you have real interest in being professionally oriented about setups that are very classic and repeat just about every single week, if not every day if you're a day trader, index futures or indices are just a beautiful bastion where this type of trading can be done. Again, you don't, unless you're seeing like employment numbers or like a FOMC related announcement, very, very rarely do you see wild knee-jerk reactions in price where it just completely blows everybody out, and then you're left guessing as what price is going to do next. This is the reason why, well, that was the reason why I went to trading from the grain markets and metals and currency futures in the 90s, and I moved into trading S&P 500. I was trading it when it was the big lot. There were $500 per contract, and then it was allowed to trade as a mini contract. So it was $500 per contract, and then it made the E-mini, which allowed it to be $50 per point versus $500 per point. And I basically just carved out my weekly setups with the bond market. I would do short-term trading in bonds, and I would day trade just about every day in the S&P market. And all I was trying to do was get 3 handles in S&P. And a handle, again, is 100 points. That would be, in this case, if we were looking at 32.40, if it went to 32.37 and it gave me an opportunity to get out, that's all I was doing. So I was looking for 300 points in an S&P move every single day. Now, back then, the volatility was so small that, that was a pretty good morning session to get 300 points and just walk away. Now, look at what we got. You have huge volatility all the time. And a day like we saw on Friday would be almost equivalent to what would be considered the crash market in 1987. So you have a huge amount of opportunity in this segment of price action to study and look for opportunities to see repeating characteristics. Back to this level here. The context is here, and we've already did our run on stops, and we know this is residing in price here, liquidity. They're going to aggressively run for those right here. This movement here is what I call the Nestea plunge. In the 80s, there used to be a commercial for Nestea and the beverage Nestea. And it would show typically a guy or a girl falling back into a swimming pool. And it would say, take the Nestea plunge. I guess they were indicating that if you drank it, you would be feeling refreshed, like going into a cool watered pool. And in my chat room, I had 1,000 people in my chat room back in the 90s. I would indicate two types of declines. The Nestea plunge, which it would look like this, or if it was like a aggressive, like 3 candles, it's just a complete obliteration on anyone that's long and running for that level, I would call that ride the lightning. And because lightning would come down really quick, and that was the 2 indications. So people would either ask me, to call it lightning, or are we taking a Nestea plunge? One of the two, that would be indicative of how the price action should trade. And this is taking an Nestea plunge. And it's just a little cute little, maybe stupid to some of you here, but that was what it was kind of like a moniker for me back in the 90s in my chat room, where I was calling S&P moves and bond moves every single day. And it was like clockwork. It's just, they're there every single day, and you can find bread and butter setups in this. For you that come in here and you go through the entire mentorship, okay, and you go through all the charter members, and when we get through all of the trading plans and we're done with all the algorithmic principles that go along with those trading plans for all those 12 models, if you don't feel comfortable in Forex, even at that stage, consider index futures. Study that. And I'm telling you, you will see it's not hard. It's just hard getting rid of the bad things you're thinking of right now. The things that you think mean something right now because you've been poisoned with retail stuff, or somebody out there that claimed to know something that don't really know anything. It takes a lot to get rid of that stuff. And the longer you've been exposed to the marketplace, the harder it's going to be for you, because you have these little pet things that you've come to love, or you've seen work a couple times and you just don't want to let go of it. And that's the trap. You got to forget all that stuff, because there's a way to do this, but you have to listen to me and purge everything that you think you know about it. And sometimes pride gets in the way of that. But back to this, this low here, I felt really confident when we traded back up into it that I could trust that low as retail would see it as resistance. Now, maybe some of you wouldn't trade it like that, but you watched me in the video that I recorded where I engaged on the basis of what I just outlined here. I didn't need it to go back up to the low of that weekly gap. Remember, this level here is the low of the weekly opening gap, and this is the high of that weekly opening gap. Price went up into this, filled it, came down, went below it a little bit, and went back up into consequent encroachment of 2 fair value gaps. The 15-minute time frame is the tan one, and the blue one is the 60-minute. So what we've done is we refined and calibrated our fair value gap with consequent encroachment, and 2 times it trades to it. Doesn't trade all the way to the top of the blue shaded line. It doesn't trade to the top of the tan one. That's how we use consequent encroachment. And narrative. The narrative is the buy stops are already cleared here. It went back up and filled the complete weekly opening gap. And now in this area here, the market is aggressively going to seek sell side liquidity. Where is it? Is it just below this low here? No. It's over here. And the previous low to the left of it is essentially 32.40. So that was the reason why I was trading the live S&P and trading. You watched me do that on Friday, and what I was looking for in context. Now, if you look at what goes on in the 15-minute time frame in index futures, you can do a lot of measured moves, and unlike what we do with standard deviations in Forex because of the algorithm in IPTA, there isn't an IPTA algorithm for S&P, but there are very specific algorithmic theories that are in play that work within this asset class. And it's very simple. If you ever see consolidations, all you have to do is get the measurement of that and treat it just like a standard deviation would be in Forex. And I'm just going to show you an example over here. We can see the high and the low inside this range. If we break below to get the sell side liquidity, how far can it go down? Well, this is one full standard deviation of this. And how I did that was I took the fib and I put it on the top high here and drug it down to this low until the 50 level. See that? 50 is laying right on top of that. So that means the 0 level, because this is a 100 level on the fib, this is a 0 level, and this is 50. I'm putting 50 right on that low here, and the expansion down is 32.14 3/4. And the low only went down to like 13 and something. Okay, it wasn't even two handles. That, to me, is precision. you can get even more precise than that, but I'm not teaching everything in this introduction to index futures. So what are we saying here? Getting short in here would have been ideal. I was looking at it when someone said, hey, do you look at S&P futures? So I went right on the S&P March contract and see if I could get something. And it just so happened that it was getting ready to trade back up into this low. And I knew by looking at it instantly, this was the context. This is exactly what I saw. I didn't mark it up on my chart and have to decide about it. When you're doing it for so long, you don't need to annotate your chart. You don't need to. You'll see it. It jumps off the chart and boom. I'm only communicating what was seen by me looking at a blank chart. That's all I'm doing. And I'm not talking about in hindsight, because you can watch me put my orders in. I adjust the stop. You can see me going in with additional entries in that video on Friday. So it's not contrived. It's not cherry picking. It's not hindsight. It's actually doing what I'm showing you I used before it actually delivered the price. Okay. So at this point here, you can be a seller and trust that you're not going back above that not fair value gap, but that weekly opening gap, and it's going to expand down, attacking the sell side liquidity. Okay. How far below it can you go? Well, the standard deviation of that range that creates that block of balanced price action, how far can it go? It typically will move about that much of a standard deviation down, and then you get it there, boom. And then that's where all the profit taking was on that particular Friday. So hopefully this has been inspiring to get you at least thinking about looking at E-mini S&P, maybe NASDAQ futures or Dow futures. I'm telling you, every single day there's an opportunity to take something out of that. Okay, there's a lesson to learn every single day. I can literally post a chart every single day, and that's my intentions in February. So we'll have 20 examples in chart form on index futures, and I will share one every single day, Monday through Friday, in the forum. And it'll just basically be simple little things to kind of like train your eye looking for some things. A lot of it will be very similar to Forex, but there are some things that are very generic and they're inherently specific to index futures. And we'll get more into that, as we talk more about this particular asset class. I don't want you to subscribe to the mentorship to think we are abandoning Forex. Okay, I'm teaching you how to read the markets. I'm teaching you how to understand and decipher price action. It does not matter if you want to be a Forex trader or a stock trader or a commodity trader or a bond trader. All of these things have overlapping themes, and it's my job as your mentor to teach you how to work and operate in the price action that's delivered from each individual asset class. And when we get into fall, we'll start doing some stock stuff and some option plays. And until I talk to you by way of Twitter, I'm sure, on Monday, enjoy your weekend, be safe, relax. Go back and look at some of the charts that you can pull up with TradingView with ESH2020. That's the symbol right here. Okay, the symbol is E-mini S&P. ESH is the month for March. 2020 is obviously the year we're in. If and when this contract expires in March, we'll roll over into the June contract. For your notes, the symbol will become ESM, as in Michael, 2020. When that contract expires in June, this symbol would become ESU, as in umbrella, 2020. That's the September delivery contract. When that contract expires in September, we would roll over into the December contract, and the symbol will become ESZ, as in zipper, 2020. Okay, so now you have all the codes to track basically what this index is going to do. And when we get into more discussions, the symbol for Dow is YMH2020, and the NASDAQ is NQH2020, and the same delivery codes, HMUZ. Okay, HMUZ. Go through the charts, go down into a 15-minute time frame, study that every single week, and do it on an hourly chart and do it on a daily chart. And I promise you, you're going to see very, very clear, discernible trades that you can spot really quick if you've been through at least month 8. If you're in that level in the mentorship, you'll be able to see a lot of stuff jump off the charts at you. If you're not at least month 8, don't be discouraged if you don't see it. Just trust me, you'll get it. I'll give you lots of examples to start training your eye for it. Okay? I'll talk to you on Monday. Again, be safe. Enjoy your weekend.